tuning into Talking Point. I'm your host, Niraj Shah. And arguably, if you are somebody who looks at the vagaries of the market on a daily or a weekly basis, it can't be a more important 24 hours than right now because of the perceivably all important Fed meet. The point is, does this really tell us too much about the near to the medium term, or does it bring opportunities if indeed there are vagaries in the market? And frankly, does it even matter in the larger scheme of things? Let's get in somebody who looks at the globe with equal aplomb as the local factors and try and marry the both with Nilesh Shah of Envision Capital. Nilesh, so good having you. It's been a while, but really good having you today. Thanks for joining in.
My pleasure, Niraj, and good wishes, and thank you for having me over.
No, the pleasure is ours. So, Nilesh, just dissect this for us. How much of an importance are you giving to this whole conversation around uh, fears of rising inflation? How much can they lead to rising yields and the impact that that can have on a sustained basis on the markets? And of course, the all important Fed meet today.
Well, it's always important. Clearly, global macros are important, and I'm not necessarily saying is they're important purely from an investment decision point of view, but they're clearly important from a sentiment point of view. Clearly, news flows and events like this clearly determine the direction of the markets or contribute to the direction of the markets in the very short term, because in the very short term, liquidity does play an important role. And let's look at the genesis and the backdrop of this, the important Fed meet, that commodity prices are at a multi-year high. Clearly, India is a net importer of commodities, and rising commodity prices, in a way, does indicate towards higher inflation and therefore higher interest rates. There are probably expectations that basically you could see basically the Fed in a way posturing towards essentially maybe saying that maybe at some point of time they may have to hike interest rates. So I think the market will want to know what the Fed is saying. But Neeraj, my sense is that, look, I think if commodity prices are rising, and the reason for that is beyond liquidity, which means that recovery is there, demand is back, and obviously the global demand and the global economy seems to be in a much, much better footing. Now, that's typically what the equity markets really want. And even before the equity markets wanting it, I clearly believe that that's what companies, corporates, businesses want, that they want a relatively stronger demand environment. And that probably gets partly reflected in rising prices. So to some extent, rising prices, rising inflation in a way is pretty much good for businesses. And if essentially, even if the Fed does signal that, we've seen really the bottom of interest rates, that's perfectly fine. It will surely spook sentiment for a few days. But beyond that, it is going to be back to demand, growth, earnings profile, all of that. And to me, that is honestly the most important, or probably the all important factor, which will essentially decide the direction of the markets.
Yeah, well put. So my question therefore, Nilesh, what's your hypothesis, since we're talking for the first time after the union budget, after quarter 3, both of which seem to be pro-growth, so to say, in terms of commentary, in terms of the government efforts. And we know that post the budget as well, on the PLI front, the government has made some serious moves even after that. So there is a walk the talk kind of thing. And it seems to be a pro-business kind of an attitude that the central government has currently seemed to have developed. What's your sense? Do you reckon that the growth hypothesis in India is so strong that it will be able to overcome some of these irritants, be it rising rates in the West and maybe some bit of liquidity pullback, or rising commodity prices and some bit of margin scale back for India Inc. itself?
Well, Neeraj, clearly believe that India represents or is a proxy for one of the best growth opportunities globally. I don't say this in terms of just the context of South Asia or just in the context of Asia, but where do we basically see a $3 trillion economy having the potential to kind of grow in high single digit? That to me essentially should always be the central kind of aspect that you really would want to kind of look forward to. Obviously, in India, realizing its potential, the government has a very, very big role to play. If at all, it has a seminal role to play. And if you look at it over the last 3 to 4 years, the government has introduced several reforms. But what I would probably think is that some of those reforms essentially were in a way conceived many, many years ago and have essentially been implemented by this government. But what we see in the last 1 year, and more so in this entire COVID and the lockdown period, is the government essentially having a transformational change in terms of the thought process. So be it labor reforms, agriculture reforms, be it undertaking policies which will essentially boost manufacturing output led by incentives, what we call as PLI, the production linked incentive scheme. These to me essentially are huge game changers. And so to that extent, in a way, it's pretty much nudging corporate India, it's nudging businesses to go out there and invest into India, invest into capacities, powered by several tax reforms, the labor reforms, and all of that. That to me was something which has been missing for a very long time. And that's something which is getting introduced. So to that extent, what started off as India being the pharmacy to the world during the COVID period, India now probably is becoming well positioned to be the factory to the world. Now, is this essentially going to happen overnight? It's going to take, of course, several years. But what this does is that it helps India accelerate its growth kind of a trajectory. And that, again, to me, I think is honestly music to the ears of investors.
Okay, Nilesh, dissect this for us. I'm glad you spoke about that it's a slightly longer term trajectory. The common and the most used reference point right now, or not really a reference point, but an investing point right now is let's migrate out of valuations which are sky high and get into manufacturing or growth at reasonable price immediately. It's almost as if you need to shift your entire portfolio out into this. My guess is that if indeed India has to become a factory of the world, and proof of the pudding will be in the eating some years out, as you said, it'll be a transient period. Is it necessary to do large scale changes to your portfolio and move out of things that have worked beautifully thus far? They might be at a slight premium on the valuation front, into the other side, of course, chosen carefully, but into the other side full scale? Or do you reckon that even if the story of India over the next few years is manufacturing and investment led, some of the other platforms currently are growing so well that you might as well stay put with them? What is your thesis and why?
Well, Neeraj, what really has always worked for me as an investor is to basically put money into things that you understand well. Now you could call them as growth, you could call them as value, you could call them as opportunities with high valuations or opportunities with low valuations. Honestly, this is honestly a very, very subjective issue. And my central message would be to basically put money into businesses that you understand well. Put money into businesses where you believe that the price is in a way relatively dislocated versus essentially the intrinsic value. And if the intrinsic value can keep growing year on year, then you are in a situation where basically you've put money into a business where the intrinsic value of that business is growing because the opportunity size is still big and the company is doing something wonderfully well to kind of make the most of the opportunity. Okay. And that's, I think, works really well. Now, obviously, of course, in the very short term, some of the things will look good and some of the things may not look too good. But I still think that India is a growth opportunity. And therefore, identify those kind of businesses which can, in a way, sustain double-digit growth and basically, essentially be invested in those kind of businesses, because that you also get the power of compounding. And I'll give you an example that if I were to kind of look at the quarter gone by, the December quarter earnings, our set of portfolio companies have been able to kind of register a high teens kind of a growth in revenues on a year-on-year basis. I'm not talking about Q on Q, but I'm talking about year-on-year basis when essentially the COVID base effect wasn't there. Okay, these are businesses, and it's a reasonably, in a way, a spread out portfolio which is across opportunities, be it consumer, financials, pharma, technology, services, material companies, engineering companies. It's a basket of companies, and these are companies where revenue growth has been in high teens for the quarter. and where the operating earnings or the operating profits have grown in essentially the 30s, again on a year-on-year basis. Okay, so to that extent, and where I still believe that the valuations are yet reasonable. Now, you may take a call that yes, here are some of these manufacturing companies which are trading at 100p multiple, which are manufacturing, mobile handsets and television sets and all of that. That is honestly not our comfort zone. The way I look at it is that buy growth at a reasonable price. That's essentially what I think is should essentially be the mantra, or is essentially a mantra which is really honestly worked for us. And honestly, we're very comfortable being on that path.
Okay. Now, before I talk about some niche pockets, just a question around what the tide might also do, right, Nilesh? Are two factors. I'm just drawing this question conversation back to where I started the previous question from. One of the beliefs is that we are entering a period of a virtuous growth cycle, and a rising tide will carry all boats, yes, but some boats even more, and some of the smaller names which hitherto were left behind because the market in its wisdom wanted to bet on certainty and not give any multiples to uncertain growth, that might change. And the multiples of some of the certain growth companies might come off, and the multiples of some of the uncertain growth companies which might have a bit more certainty than the past might actually move up, read small caps. Do you subscribe to this argument that one, we will enter a period of virtuous growth cycle, and that by itself will really propel the multiples of some of the small caps?
Well, I clearly believe that that Niraj, basically India is entering into a period of a virtuous growth cycle. So I have to kind of look at the last maybe 5 to 10 years gone by. India is middled around 5 to 6% kind of a growth, kind of a number. My view is that going forward, we probably will kind of grow at a substantially higher pace in the next 10 years versus where we have grown over the last 10 years. And more importantly, the quality of growth is going to be better. But I clearly see a period where several small-sized, mid-sized companies will be able to grow at a significantly higher pace versus their peers in the large cap space. And I clearly believe that's because you're seeing a very broad-based economic growth. Number one. Number two is that for some of these small and mid-sized companies, the business models have evolved. Their management capabilities have evolved, and from being pure owner-driven companies, they're becoming now owner-cum-professionals-driven kind of companies, and that I think is adding alpha, if I may use the word, to these businesses. Third, and most important, is their ability to address one large market called India, pretty much in a much more shorter time frame. Because I think of two things. One is GST has essentially changed on the ground dynamics, and clearly has tilted the scales, or has made the scales more balanced between large companies and smaller companies. And second is digitization and the power of technology, the power of online, that over the last couple of years, data penetration essentially is becoming more and more all-pervasive. And that is helping small and mid-sized businesses reach out to consumers and households which are essentially into the smaller cities, towns, villages of India, and therefore essentially are giving these smaller companies access to one large market of 200 to 300 million households. And that, I believe, is going to be powering the growth for many of these small and mid-sized firms. And therefore, I think from a 5 to 10 year perspective, they seem to be way more favorably placed. And on top of that, as investor, for me, the price I pay is as important. And therefore, the valuations, essentially, I believe on a relative basis are attractive. So I clearly believe that the small and the mid-cap space essentially is going to be the sweet spot as far as India goes over the next several years.
Well, Nilesh, can you give us one example of where you believe this this whole parlance might be playing out, that the access to a small company, which might be a very efficient manufacturer, if you will, or a service provider, if you will, is now getting access to a much larger market, which hitherto it didn't get? Which theme, which sector? I mean, any one example just to help us understand?
So if I were to kind of look at some of the smaller consumer kind of companies, and if I were to kind of look at even within that, a company that we own, a company called TTK Prestige, which makes kitchen appliances, consumer appliances. Now, so far, it's been predominantly a regional company, more prevalent in the southern part of India and a bit towards the western part of India. But now, thanks to basically GST and thanks to essentially the digitization and online players stepping in, clearly a company like TTK Prestige has access to a much larger market, which is essentially including the northern, the central, and the eastern India. And this helps us not only by helping it sell its kitchen appliances to basically the 200 300 million households that are there, but it can introduce products at a much faster pace. Another company and in which we also have an interest is a company which has traditionally been into pain management, congestion management, and it introduced its sanitary napkins just a few years back. And is after taking care of all the teething issues, it's now been able to kind of launch its sanitary napkins pretty much on a pan-India basis, partly because of the physical distribution reach it has in some pockets of India. But basically, again, the online mode of selling is helping to reach essentially almost the 500 million women consumers which are there in the country. And that's helping its business, this particular product, grow at a 40-50% CAGR year on year. And I wouldn't be surprised if it can sustain this growth over a multi-year horizon. So these are some of the examples which I believe were not there 5 or 10 years back. But these are some of the businesses which are enjoying the tailwinds of both the tax reform introduced by the government and, of course, the advent of technology which was introduced across the globe and in many developed markets many years back and is now getting introduced in India in a full gush manner. And these, I think, I believe, are significant tailwinds for some of the smaller businesses, and that puts them, and it in a way creates a level playing field for them.
Yeah, well, very interesting, the kind of themes that you're talking about. But since you referred to technology, Nilesh, I have two questions, one after the other. The first one is, what's happening with mid-cap IT, Nilesh? The valuations have skyrocketed in a manner wherein they are eclipsing some of the larger peers as well. And then in the midst of this all, I would love you to maybe spend some time helping us understand the fancy that the market seems to have gotten with the digital revenues of all the companies. And then there is, of course, Happiest Minds, which is 97% digital, and the valuations are just gone through the roof. So what's happening with this whole space currently?
So, well, several things which are really happening. I mean, firstly, over the last maybe 3 to 4 quarters, India's technology services sector has essentially enjoyed some really strong margins. Those margins have come in from a more favorable currency, and those margins have come in because essentially of lower operating costs because of more the work from home and reduced travel and things of that kind. So that's essentially, in a way, up the margin trajectory for the sector as a whole. So you're clearly seeing record margins for some of these businesses, number one. Number two, this whole shift towards digital, the shift towards cloud, essentially, I think is for real. And obviously, this as a phenomenon was there even before COVID, but clearly the COVID and the lockdown, in a way, has fast forward this opportunity. So you're clearly seeing a lot of businesses globally now wanting to entirely shift to the cloud. And if you look at some of these cloud service providers, be it Amazon, be it Microsoft, all of them, they've been growing in high double digits. And some of the technology companies, India's technology companies, are partnering with the likes of Amazon and Microsoft and IBM to essentially provide or enable this shift towards the cloud. And that's essentially likely to provide strong tailwinds to revenue. So that I clearly believe are the two big positive business levers which are essentially out there. And that's what is essentially beginning to get factored in terms of the stock prices. The third important part essentially is there's significant amount of M&A activity happening. Niraj, if you recollect a few years back, a lot of private equity funds had stepped in and bought into some of the small and the mid-sized IT services companies. And we also saw a company like L&T go out there and buy into Mindtree, for example. Now, what we are right now currently seeing is a lot of consolidation happening. A lot of the tier 2, tier 3, mid-cap, small-cap IT services companies are essentially becoming part of the consolidation and the mergers and acquisitions. In addition to that, some of these tier 2, tier 3 IT services companies are being led by CEOs who are coming in with a very solid track record from larger firms, which in a way places some of these companies very favorably to make the most out of a multi-billion, or I would probably say a multi-trillion-dollar global opportunity. So I think a confluence of several business and other factors is essentially kind of in a way getting manifested into the stock prices of some of the smaller and the mid-sized technology services companies.
But let me ask you, Nilesh, and I'm using these only as examples. I'm not asking you to comment on an individual name. And viewers, please remember, if Nilesh is using some examples, it is to enumerate or make his point, really, not a buy or a sell recommendation, any stretch of imagination. You have to do your own due diligence. But Nilesh, my question is this. There are a couple of large cap IT companies, HCL Tech Mahindra, for example, trading sub 20 times, arguably, maybe even lesser, maybe 18 times. And some mid cap IT companies which might grow better than these and trading in much higher multiples. My question to you is, would you be comfortable giving a higher multiple to a mid-sized company because the growth rates for the next 2-3 years might be higher versus the stability that some of the larger names provide? Or is it very, very bottoms up in case-to-case basis?
Well, our investment strategy and our philosophy has always been bottom up and will remain bottom up. Okay. And I'll probably kind of give 3 examples very briefly that amongst the larger IT services companies, technology services companies, HCL Technologies is our preferred kind of a bet. And if I were to kind of look at the last 10 years, Niraj, over the last 10 years, HCL Technologies, I think, has been essentially the best performing business as well as the best performing stock. So clearly, I also am driving home the point that basically a best business or a company which does well on the business does eventually get rewarded by the stock market. Okay. So HCL Technologies is essentially our preferred play. Valuations are attractive. Its growth profile over the last 10 years has been better than most other technology services companies, and valuations, of course, are reasonable. So we like that. The second company that we like essentially is a mid-sized company called L&T Technology Services Companies. We've been owning the stock for years. We like what they do. They're doing something which is very specialized, not very easy for others to do, and they're in a space called the ER&D space, where they work with Fortune 500 companies to deliver cutting-edge technology solutions for those clients as well as for their end clients. The third company that we like is again a small IT services company called Buildasoft, which essentially just come out of a bit of consolidation, and which has tremendous and is doing some interesting things on the cloud side, which provides it a lot of tailwinds in terms of growth. But second, it has tremendous potential to improve its margins going forward. So its margins have been in the low teens. If those low teens translate into high teen margins, that will translate into pretty strong earnings growth over the next 3 to 5 years. So we clearly like a combination of this, be it large cap, mid cap, small cap, and again, goes on to show that we remain bottom up in terms of our investment style.
Yeah, most certainly. Nilesh, just a word on the niche tech-enabled pockets that are starting to come in, because this year would be a year of arguably tech IPOs, right? We're starting off with Nazara today, but a bunch of others lined up as well. Now, each of these might have some or the other niche element to them, and the argument is skewed wherein the few skeptics argue that, oh, if you look at the traditional metrics, these companies are just so overvalued, and the people who are bullish say that the runway for growth is so large, and in India we may not have experienced it, but we've seen that in the West, and it'll get replicated in India, wherein the valuation models will move towards the runway for growth and how much these companies can grow for the near term versus strictly looking at PE multiples all the time. What is your sense out here, Nilesh? Can India graduate to that as well, or do you think there's something else at play here? I may be wrong.
Well, yeah, sure. I clearly believe that the name you mentioned, Nazara Technologies, and gaming essentially is going to be a very big business. And I mean, look at it. We have a captive population of 1.4 billion people, the world's youngest population. More than 2/3 of the population is below the age of 30. Pretty much, in a way, the ideal market size that anybody could dream of. So to that extent, of course, the tailwinds are very strong. And the challenge always is, and there's a saying, Niraj, that Wall Street looks at investments linearly. Silicon Valley looks at investments exponentially. So whether a business can grow exponentially, and when a business grows linearly, of course, the valuations that you pay for become important. But when a business grows exponentially, then honestly, the valuations don't become too important. And that's essentially a pretty much a kind of a battle that every investor has to kind of, in a way, grapple with. It's an issue which we all have to grapple with. And in the process, we will be early in some of these businesses. In some cases, we may not be so early. But having said that, I clearly believe that we remain constructive about such opportunities. We're keeping our eyes and ears open to some of these new businesses, these high potential businesses. And at some point of time, if the valuations do make sense, we are very happy to kind of, in a way, participate into them. But of course, some of these businesses are still loss making. And generally, as a philosophy, we would prefer to invest into businesses which are profitable, are growing capital in a capital efficient manner, and are generating the cash flows to be able to fund that growth going forward. So that's how the way we are seeing some of these newer IPOs which are coming in and getting listed.
Any thoughts on the others, Nilesh? I mean, without getting into names, but I'm just saying that specialty chemicals is not a new thing. It's been around now for a decade. Companies are coming in between 40 times to 80 times to 90 times multiples, whereas some of the listed peers and ones which are also promising growth are maybe 25, 30 times, which the market in its wisdom believed was expensive. Why such subscriptions? And rolled into that is the question that it is not just the retail subscription. There is some institutional appetite for such issues as well. Why would this be happening?
Well, in the sense, Niraj, it's pretty much like it's like the new always essentially comes in, and the old in a way gets sidelined. If you remember earlier when we used to keep actually in a way some cash with us, and when we had to make payments, we'd always give an older note away and try and keep the new note with us. Okay, it's pretty much the same kind of in a way institutional imperative which some of the investors are demonstrating right now, that they prefer to kind of look at a new company which is getting listed and are happy to pay a 50-100% premium versus a company which is already listed. And that's why I come back early, that if you remain bottom up, then you will essentially be able to kind of, in a way, ensure that bias doesn't creep in. And I completely agree that some of these specialty chemicals IPOs are getting priced way too high, purely because there's probably a lot of money which is chasing that. And I think investors are just looking to basically flip on listing. And you've seen in the past that some of these companies are not able to live up to the expectations that investors had in them when they got listed. So I clearly believe that I think no matter what it is, no matter how great the growth prospects are, but you need to essentially ensure that you are willing to pay probably just a fair price or a reasonable price. Of course, that's again a very subjective decision, but nevertheless, it's important that you essentially ensure that you don't overpay for a business. And I think overall, but I still believe, Niraj, that specialty chemicals, pharmaceuticals, I think is a very, very long-term and a structural opportunity which India has to offer to the rest of the world. So far, we have been more constructive towards pharmaceuticals because we clearly believe that these are businesses which have been around and have scaled up quite well, scaled up rapidly, have made a dent into a very large and a regulated market like the United States. As we know, India has the largest number of US FDA approved facilities outside the United States. And we clearly believe that some of our pharmaceutical companies are on a path of solid double-digit growth for maybe a very, very long period of time. And therefore, we like that opportunity quite a lot.
Yeah, I was going to ask you to reiterate that point because we had spoken about it earlier as well the last time. And thanks for doing that. I have one final question, Nilesh. And I, for the longest time that I've looked at your portfolios, you have in some way or the other participated in the capital market link plays, whether it be through exchanges, through depositories, through AMCs, and otherwise. Yesterday, we published this story about India's second largest broker, discount broker, being the sponsor of IPL. And that got the eyebrows raised, right? That there is clearly something happening out here in the Indian landscape. So what do you reckon is the most efficient and a long-term way of playing the India capital market story? Is it brokerages? And it could be a combination, really. But is it brokerages? Is it AMCs? Is it maybe insurance as well? Or some of these niche plays like exchanges or distribution or depositories, etc.? How do you think what do you think is a good way of playing the capital market story in India?
Well, Neeraj, this is again a very interesting theme that you've brought, and I clearly believe that India is at the cusp of increasing formalization and financialization. Millions of people in India are turning from being just savers to being investors as well, and therefore there are a variety of businesses, some of which are platforms, some of which are basically excellent product plays. So the way we're really playing this right now is through the AMC route. We've been owning a very respected AMC and a mutual fund company called HDFC AMC. We've been owning it now for at least a couple of years, and we like that. Really believe that AMC as an opportunity probably in India is not just probably a multi-year, but maybe a multi-decade opportunity. Given that in a country of 1.4 billion people, we just have 20 million unique investors into mutual funds. So clearly, this is, as a business can potentially be several multiple times its current size. Even in terms of AUMs as a percentage of GDP in India, it still is 10 to 12% versus 40 to 50%, even in some of the other emerging markets like Brazil and South Africa. So again, a huge runway of growth, solid tailwinds. So we like it. But what we like the most about a mutual fund business or an AMC business is essentially high return on equity. These are businesses which do not require capital for growth. All that they need to do is to ensure that they do a good job out of performance, they do good investor servicing, and keep growing on a year-on-year basis. And this is what we really like about the mutual fund business. So if you look at some of these businesses, they enjoy return on equity, return on capital in excess of 30%. So it's rare, Neeraj, to come across a business which has the potential to kind of at least grow in mid to high teens and can have return on equity in excess of 30%. And that's what excites us the most about this business in the entire overall capital markets or the investment arena kind of a space.
Nilesh, this was insightful in more ways than one. And I thank you for joining in today and giving us your thoughts. It was a pleasure having you. And I look forward to talking to you a little bit more often than what we do these days. Thanks so much for joining.
Sure, Niraj. Always a pleasure. Looking forward. Thank you so much.
Thank you. And viewers, thanks for tuning into this very, very insightful session of The Talking Point.